there, Holly Shields here for Kalkine Media. What are quant funds? Before we get into it, please sub to our channel and press that bell icon to stay ahead of the game. Quant funds are a type of mutual fund in which every aspect from asset allocation to stock picking is dependent upon the predefined rules. The choice of assets in the portfolio of quant funds is based upon automated systems, and generally the fund manager does not have any say in the process of decision making. The time of entry and exit is also decided by the automated system. However, unlike index funds, quant funds involve fund managers in certain aspects. The fund managers are engaged in designing the model and monitoring the model, which is deployed for making decisions regarding the portfolio. Mutual fund companies provide quant funds, and the quantitative models are also employed by the hedge fund managers for designing their portfolio. So, what's the significance of quant funds? Well, the utilization of the quantitative models while making portfolio-related decisions and picking up the stocks results in the removal of the human interface. That is, bias is not present when stocks are chosen. For example, when a fund house employs a quantitative model which selects the stock on the basis of historical returns and the growth potential, then the model will not pick the stocks which are volatile or leveraged. Moreover, the quant models are efficient in providing consistent results irrespective of the market conditions. When the market is dominated by the bearish trend, then the managers of the actively managed funds are forced to leave the market and rethink their investment. However, quant funds are managed in a passive manner, and therefore the expenses are comparatively lower. Furthermore, the quant fund models have inbuilt checks on sectors and stock concentration. But what risks are associated with quant funds? Well, some academics have presented the opinion that there is a systematic risk present in quant funds. This makes quant funds unable to embrace the idea of letting a black box run its investments. The amount of the successful quant funds in the market is close to the amount of unsuccessful ones. Moreover, when quant funds fall, they generally fall big. Long-term capital management was a famous quant hedge fund. The quant hedge fund gained its reputation as it was run by Robert C. Martin and Myron S. Scholes, respected economists who won 2 Nobel Memorial Prizes. In the 90s, the fund was able to generate above average returns, and the team was able to attract capital investment from all ranges of investors. The reputation was gained because of their strategy. It was not limited to exploiting inefficiencies, but the team was able to leverage on their bets on market directions, as they had easy access to capital. The strategy was the actual reason for the collapse of the long-term capital management, or LTCM. In the early 2000s, the company was dissolved and liquidated. The model was not efficient in taking into consideration the defaults done by the Russian government in its own debts. One even triggered the events and chain reaction leading to the liquidation of the company. The collapse of the company created havoc as it was heavily involved in a range of investment operations, and its collapse dramatically affected the world market. At last, the Federal Reserve stepped in to control the damage created by the LTCM by supporting them. The quant team is employed to constantly upgrade the models for predicting future events. But the aspect that the future can be predicted every minute should not be ignored. The quant funds can be overwhelmed in case the market and economy are undergoing more than average volatility. Moreover, the high turnover is accompanied by taxable events and high commissions. A quant fund can be dangerous, especially when they are based on short-term strategies or marketed as bear-proof. When the downturns are estimated by using derivatives and combined leverages, can add risk. So what are the advantages of using quant funds? Well, the management style of quant funds is different from the traditional fund managers. Thus, they're classified as an alternative investment. The cost of quant funds is low as portfolio managers and traditional analysts are not required for running them. The cost of trading is generally high because of the higher turnover of securities when compared with the actively managed funds. The offerings are more complex, and it's common that they target high fund entrance requirements or high net worth investors. Investors consider quant funds as highly technical and most innovative technology-based offerings in the universe of investment. The quant fund encompasses an extensive thematic investment style and incorporates groundbreaking technologies. Most of these strategies begin with the benchmark or universe, and sectors are used and industries are weighed in the models. This strategy allows the scope for the diversification and the model is not compromised. So why should quant funds be used? Well, the quant funds utilize algorithms and computer models to make predictions. Therefore, the scope of human error is eliminated. Also, the cognitive and emotional biases are eliminated. Rule-based investment techniques are employed for building the portfolio and shortlisting the stocks. The role of fund managers is limited as predetermined rules are suited for filtering and picking the stocks. The models are reviewed on an annual basis and tweaks are made. The most experienced investors and fund managers may fall prey to behavioral biases. Therefore, by creating quant funds models, an investor can create rules based on their fundamental and technical analysis. Well, if you like this info, please give us a like, comment, and a share. Please sub to our channel, and while you're at it, press that bell icon. For regular updates and info, log onto our website at kalkinemedia.com. This has been Holly Shields for Kalkine Media.